Well, thank you, Sylvia. Thank you for that very kind introduction. And indeed, as you said, in October 2020, I asked the question at this very conference, is inflation dead or hibernating? And today I would like to assess how things have changed since then and what the prospects are. As you indeed also reminded people, my conclusion at the time was that inflation was hibernating. Now, I think that if you just stop there, you would say, oh, well, wow, how prescient he was. But in fact, the answer is a bit more complex than that. The bottom line today is that inflation has actually come sooner, it has been higher, and it has been more persistent than we had originally expected. Still, I don't quite see a change in a fundamental change in the inflation regime. And that said, as I had already suggested in 2020, I think that the prospects further out into the future, in the long term, could be for there is a risk that inflation could actually become more endemic. But let me say a few words about each of these two points. So what was the assessment in October 2020 about the short-term outlook, say 2 to 3 years? So let me read it so that what I'm going to be saying will make sure that I don't sound artificially good, okay? So let me quote. In the short term, disinflationary pressures are likely to prevail. Granted, there could well be, and we have already seen, some cost push pressures, and probably there is more to come. But if the previous analysis is correct, they are more likely to generate one-off increases in prices than persistent increases in inflation. Second round effects would remain weak. We can expect economic slack to prevail, albeit clouded by the pandemic-induced resource misallocations or reallocations. Meanwhile, we can expect the forces of globalization, even if naturally waning, and technology to continue exerting downward pressure on inflation for at least some time. So remember, this is October 2020. Now, what has happened since then? Clearly, inflation has been higher and more persistent than we expected, including at the BIS. Now, when I think of this process, what I like to imagine is that think of an engine that you have switched off for quite some time during indeed a cold winter. You've added some fuel to it, and then you've kicked it really, really hard. I think that what is happening now is very much a reflection of that. The kind of dislocations, the ruptions that we see are part of the same picture. Now, metaphors aside, what do I mean? Well, first of all, aggregate demand has been much stronger than expected. We have seen a release in pent-up demand following an artificial suppression of economic activity. And on top of that, we've seen a huge policy response, in particular from fiscal policy that was not anticipated at the time. Also, aggregate demand has been different from what one had expected. There has been a rotation away from services towards goods, but there has been no rotation back. And at the same time, supply has proved to be quite inelastic. Now, a reflection of all of this is bottlenecks, which have received quite a lot of attention recently. So let me spend a few words on this phenomenon, which, by the way, was discussed in quite a lot of detail in an article that came out in the BIS bulletin some time ago, and I would strongly advise you to read it. I think it makes a very interesting read. So where are the bottlenecks biggest? Raw materials, intermediate manufactured goods, and freight transport. Think of semiconductors, computer chips, shipping costs, also air freight, and truckers. There is a shortage of truckers even. Now, since these bottlenecks have been concentrated in the early stages of the supply chains, their impact on economic activity down the road is bigger. Now, we have estimated, based on global input-output matrices, the final impact of these disruptions on the supply of energy commodities and semiconductors is on average 3.5 to 4.5 times bigger once the disruptions reach a final output. So, for example, a 10% decline in the production of world semiconductors would reduce GDP, global GDP, by something like 0.2 percentage points. And in some cases, countries like Germany, where the automobile sector is highly developed and very important, the impact could be something like 0.5 percentage points of GDP, the impact of what we saw, the disruptions that we actually saw. Now, the estimate, the mechanical estimate on inflation can be large too. So my colleagues have estimated that if the energy and motor vehicle prices in the United States and the euro area had increased since March at their average rate between 2010 and 2019, think of this as the benchmark, then year-on-year inflation in the United States and in the euro area respectively would have been 3 and 2.5 percentage points higher. So that's a big impact relative to the overall increase in inflation that we have seen. Now, initially, these bottlenecks reflected mainly constraints on supply, pandemic-related constraints or bad weather. But later, more fundamentally, they did reflect demand. First of all, the sudden surge in demand. In fact, in several sectors, output has been considerably higher than pre-pandemic. For example, semiconductor exports from Asia to the rest of the world, or the processing of ships' containers in the United States and in China's ports. And the supply of raw materials has also held up very well. And secondly, besides the increase in overall demand, there has been a big rotation of demand towards manufactured goods, which are naturally more dependent on raw materials and on the supply chains. In addition, bottlenecks were exacerbated by precautionary demand, or the so-called bullwhip effect, the shift from just-in-time to just-in-case inventory management, working through highly complex global value chains, which have been designed to minimize costs regardless of geography. Now, let me sort of stand back a little bit now and look at near-term prospects for inflation over the next 2 to 3 years, but in a more holistic way. Well, there are some good news and some less good news. So first of all, let me mention the good news, and I will mention three points. First of all, we know that bottlenecks will dissipate, even if we don't know exactly when. And in fact, we might even see some excess supply in some segments of production as precautionary demand subsides and as new supply comes on stream. This would be the reverse leg of the bullwhip effect that I mentioned earlier. Second, as I mentioned, in fact, in 2020, I still think that secular disinflationary pressures are at work, although they may be waning. And here, the role of globalization, but also the role of technology matter, because they have tended to reduce the pricing power of both labor and of firms. And finally, and this is something that may not be fully appreciated, the behavior of inflation after it has settled down to a low level can actually help policymakers. And this is something that we examined in some detail in an article that came out in the BIS quarterly review. I think it was in September. And essentially what we do there is that we look at the United States at a very, very disaggregated level of prices, of sectors. And we tend to find that when inflation has settled at a low level, there are self-equilibrating forces. Inflation tends to be range-bound. And there are basically two reasons for this. The first, and again, I don't think that this has been fully appreciated, is that what we measure as inflation, when inflation is low, is largely, in fact, the result of idiosyncratic or relative price changes, not of a generalized increase in inflation, which is closer to the theoretical definition of inflation. Another way of putting this is that the common component of inflation, think of it as true inflation, falls sharply once inflation settles down to a low level. So it goes down to something like 20% of the overall change in prices. And secondly, changes in prices tend to be transitory. And to the extent that you have trend relative price changes, these trends do not accelerate, so that their contribution to inflation is constant. Now, if you look at the more recent case, you will find that the price of energy and the price of cars really account for a very large proportion of the overall increase, although clearly inflation is spreading. Now, what are the less good news? Well, first of all, is that events are really shaking the system very hard. And I think the next thing to watch, which we should all watch very carefully, is what happens to wages for the possibility of second-round effects, because it's really wage price spirals that are the essence of inflation, as opposed to changes in relative prices, in this case, the relative price of wages compared with prices. Now, so far, the evolution of wages has been quite uneven. There have been strong pressures in the United States, which of course is the director of the global monetary and financial orchestra, so it matters a lot for the rest of the world. Second-round effects have also been prominent in many emerging market economies, particularly in Latin America and also in others, but far less in Asia. And there, indeed, central banks have already had to tighten, partly because of the depreciation of the exchange rate. But they have been less strong elsewhere, including, I would say, in the euro area. Now, for example, in the case of Germany, however, we will have to wait till the second half of 2022, because that's when the bulk of the contracts will be renegotiated. Now, the second piece of less good news is that to the extent that central banks will have to respond, compared with the past, they may have to respond more strongly. And that is because there is quite a lot of evidence that the Phillips curve has become flatter, so the relationship between economic slack and economic activity. So that means that when you're trying to keep inflation under control, when inflation is already under control and you're pushing in order to get more economic activity, then a flat Phillips curve is your best friend. But it can become your worst enemy when you're trying to tighten monetary policy in order to bring inflation down, because the cost in terms of economic activity will be higher. And the third piece of evidence is that monetary policy operates through a remarkably narrow set of prices. And this goes back to the piece of research that I mentioned in the quarterly review. We find that it operates, you can actually find an effect even 2 years after the initial tightening of policy or the initial loosening, the initial shock. You can find an effect which is statistically significant only for 20% of prices, again, 2 years after the initial shock. So what's the bottom line of all this? Well, could we have further inflation surprises on the upside? Definitely, yes, we could. But are we witnessing a kind of change in the inflation regime so that inflation becomes endemically and uncomfortably high above targets for central banks? I don't think so. And clearly, central banks are there also to make sure that that doesn't happen. Now, so much for the near-term effects. What about the long-term prospects? And here, I think the picture is somewhat different. And going back to what I said already in 2020, I think that I would not definitely rule out the possibility of inflation becoming more endemic and becoming a problem. Now, let me stress, when I talk about the long term, I don't really talk about calendar time. I don't really have a crystal ball. I'm really talking about economic time. That is, time as marked by those fundamental changes in policy regimes, which tend to shape the economic environment and therefore the broad evolution of the economy, including therefore of inflation. Now, what could that change in regime look like? Well, imagine a world in which we have very high debt, public and private, a world in which globalization is in full retreat, a world with a bigger role of the state in the economy, especially if supported by less market-friendly philosophies. Indeed, this would be an environment closer to the one that we saw in the 1970s. Now, are there incipient signs that we may be gradually moving in that direction? Well, there are some such signs. Clearly, debt levels are at historical highs. Globalization has been losing some steam. And indeed, also the unit labor costs in China and the rest of the world have been converging. The pandemic has given a further push to the role of the state in the economy. But clearly, it is still too early to tell. Now, if this world materialized, should this world materialize, then it would provide fertile ground for inflation, because labor and firms would regain a lot of the bargaining and pricing power that they have lost over the years, since at least 30 years ago. And there would be both the incentive and the means, therefore, to inflate the debt away, supported necessarily by some form of financial repression, and typically going alongside the political economy pressures on central banks. Now, this is clearly just one possible world, but I think it's a world that we should consider carefully. And this was the sense in which I meant that in October 2020, that inflation was hibernating, as Silvia said, possibly a long winter, but then a winter after all. So, thank you very much.